Okay, let's dive straight into this explainer. Today, we're putting Genius Sports through the ultimate stress test using some of the most legendary investment frameworks ever created. We're literally taking the raw data from their latest financials, throwing it into a valuation gauntlet, and seeing what this multi-billion-dollar sports betting engine is actually worth.
So here's our guru gauntlet for today. We'll start with the company snapshot, look through the Warren Buffett lens, then the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll do some DCF and multiples valuation, and finally, wrap it up with our synthesis and verdict. Let's get to it.
Section 1. Company Snapshot. Let's establish the baseline reality here. Genius Sports, trading under the ticker GNI, is essentially the official data partner and tech engine powering sports betting globally. I mean, they hold exclusive rights with the NFL and NCAA, which is huge. And recently, they made this massive strategic shift, dropping $1.2 billion to acquire a company called Legend. Why? To radically expand their reach into fan engagement and digital media.
Now, consider these numbers, because we're staring at an incredible paradox just hiding in plain sight. For fiscal year 2025, they posted a blistering 31% revenue growth, hitting $669.5 million. And they generated a healthy positive free cash flow of $64.5 million. But, and it's a big but, their reported GAAP net income is deeply negative at minus $111.6 million. So with a market cap of $17 billion and roughly 250 million shares out there, we're looking at a stock price of around $6.80. The question is, are we looking at a hidden bargain or a massive trap?
Moving on to Section 2, the Warren Buffett lens. Let's look at moat versus earnings.
Buffett's philosophy is legendary for a reason, right? He looks for an impenetrable economic moat, consistent earnings, a high return on equity, honest management, and manageable debt. And he wants all of that purchased with a solid margin of safety based on what he calls owner earnings.
But when we actually apply Buffett's checklist to Genius Sports, man, we get a really mixed bag. Do they have a moat? Yes, absolutely. Those exclusive NFL and NCAA data rights are incredibly hard for anyone else to replicate. Is the debt manageable? Also yes. They've got a debt-to-equity ratio of just 0.56 and hold over $280 million in cash. But here's where it totally falls apart for the Oracle of Omaha. Earnings consistency is a hard NO because of those persistent GAAP losses we mentioned. Plus, they drastically fail the high return on equity test, coming in at a negative 15.4% ROE in 2025. Ouch. Even if we try to be generous and calculate his intrinsic value using their $64.5 million in free cash flow as a proxy for owner earnings, Buffett would still demand a massive margin of safety. Ultimately, his verdict here is a pass. Because of those heavy, persistent GAAP net losses, there is literally no price at which Buffett would buy this stock today. It just flat out violates his golden rule of predictable profitability.
Okay, Section 3, the Peter Lynch lens. Growth at a price.
Now, Peter Lynch loves growth, but only at a reasonable price. He likes to categorize companies first. Is it a slow grower, a fast grower, a stalwart? And then he relies heavily on the PEG ratio. That's simply the price to earnings divided by the growth rate. He also keeps a close eye on strong balance sheets and insider dynamics.
So, applying this to Genius, they are clearly a fast grower with that impressive 31% top-line revenue growth. But here is the roadblock. Their earnings per share is negative 44 cents. The math on the PEG ratio literally breaks down here. We can't even calculate it. However, because they do have a solid balance sheet with low leverage, Lynch wouldn't necessarily short it or run away completely. His verdict would likely be a hold. It's a great growth story for sure, but he'd want to wait for earnings to actually turn positive to properly value it.
Next up, Section 4, the Benjamin Graham lens. This is the ultimate stress test. Benjamin Graham, the father of value investing, is ruthless. I mean it. His defensive investor checklist demands hard assets, unshakable earning stability, a solid dividend record, and a very strict intrinsic value formula. And this is exactly where old-school rules violently collide with modern tech. If you try to calculate Graham's famous intrinsic value formula, which, remember, is the square root of 22.5 times EPS times book value per share, it just breaks. You get an error. You're trying to take the square root of a negative number. Graham's 1940s calculator basically just caught fire. Because he strictly requires positive earning stability, he would instantly reject this stock at any price. Verdict? A hard, unequivocal pass.
All right, let's leave the old masters behind. Section 5, DCF and multiples. Time for some modern math valuation.
To truly see what this company is worth based on its actual cash generation, we need to build a discounted cash flow, or DCF model. The steps are pretty straightforward. We forecast the free cash flows, calculate a terminal value for perpetual growth, and then discounted it all back to today using a weighted average cost of capital, or WACC. Now, because our source data lacks specific cost of capital metrics, we're making some standard tech industry assumptions here, specifically a 10% WACC and a conservative 3% terminal growth rate.
Now this is where the story gets really compelling. If we just use their base FY25 free cash flow of $64.5 million, it looks okay. But we have to factor in the Legend acquisition. The company is guiding for a pro forma EBITDA of about $320 to $330 million next year, with a stated 50% free cash flow conversion rate. That means their projected free cash flow jumps to roughly $160 million. When we run that through our DCF model, we get a fair value estimate of around $12 per share. That is a massive potential upside compared to its current trading level of roughly $6.80.
But there's always a catch with DCF models, right? They are incredibly sensitive. Think about the sensitivity here. If we assume slightly higher risk and shift our discount rate just a couple of percentage points up to 12%, that fair value plummets down to the $8 to $9 range. It really highlights exactly how volatile these future cash flows are to value today, and that directly impacts your personal portfolio risk.
Let's look a bit deeper at those risks. Section 6, multiples in distress. So if we apply a comparable enterprise value to EBITDA multiple, let's say a 15x multiple on their projected $270 million standalone EBITDA for 2026, we actually get a highly optimistic $16 price target. Awesome, right? Well, hold on. Our financial health data is flashing massive red warning lights. Their Altman Z-score, which is a key predictor of bankruptcy, sits at 1.41. Anything below 1.81 is literally the distress zone. Even worse, their interest coverage ratio is completely at risk, sitting at an alarming negative 25,221 times. That is an absurdly bad metric. It means their operating income is nowhere near covering their interest expenses right now.
Okay, Section 7, synthesis and verdict. Let's tie all of this together.
We're basically staring at an extreme financial paradox here. On one hand, we've got massive revenue scaling, incredible market capture in sports data, and strong free cash flow generation that's being supercharged by that $1.2 billion Legend acquisition. But on the other hand, we have severe GAAP net losses, broken traditional valuation metrics, and literal bankruptcy distress signals flashing via the Altman Z-score. As an investor, you're forced to choose which side of this paradox you actually believe.
So, here is our final scorecard. The traditional gurus, Buffett and Graham, they demand you stay far, far away until net income actually turns positive. There's just no price that triggers a buy for them right now. It's a pass. Peter Lynch says hold, but our modern cash flow model suggests major upside, with our DCF pointing to a $12 fair value. Blending all of this together, our final verdict is a speculative buy. The upside is very real, but honestly only for investors who believe free cash flow is the ultimate truth and that this company can outrun its GAAP distress signals.
Which leaves us with the ultimate question to think about. Are the strict valuation methods of legends like Buffett and Graham simply obsolete in today's software and data age? Or are modern tech investors just willfully ignoring the glaring distress signs? That, my friends, is the billion-dollar question with Genius Sports. Thanks for joining me on this explainer, and remember, keep doing the math.